Hello, everybody. This is our second episode of our mortgage industry topic that we're diving into here. I'm here with Tim Holley, broker and owner of Long River Realty. I am Jaredsrail of Long River Realty and also JR Appraisal Services. And we are here with Heather Petrillo. I'm probably butchering your name. It's Petrillo, isn't it?
It's actually Petrillo.
It is
Several people
Petrillo.
say
Okay, so
Petrillo.
Heather Petrillo with New American Funding. I apologize. I want to make sure I'm getting the name right as I'm putting it out there to anybody who's watching. How are you today?
I'm good. Good. Staying
Good.
busy. Feels good.
Great. So, Heather, we are diving into our second segment now with you on the mortgage industry and mortgage related topics. And, we left off our last episode talking about pre-qualifications, and we want to dive a little bit more into that and then dive into the whole process of the loan and how that kind of goes.
Yeah.
Um,
So take it away, Heather. It's all yours.
All right. So I mean, in lending, there's several steps to this whole thing from start to finish, right? But in order to get to step two, step one is pre-qualification. And that is where the potential buyer and myself have a conversation about their situation. We talk about their income, their assets, their credit, right? So through this pre-qualification, we get, at least I go pretty in depth, right? So it starts with our names, of course. Do we own a home? Are we renting a home? If we own a home, what are we going to do with that? Are we going to keep it? Are we going to sell it? Are we going to be contingent? Do we need to sell this home to buy a new home? Right? We're going to talk about those. Do we have a mortgage payment on that? Impounds, all that little finite stuff. Okay. Second to that, do you own any other properties? Are we owning any vacant land? Are we owning any rental properties? Do you have a property that your sister just, lives in? And, what does that look like? Right. So we're going to talk about that. If a client has investment properties, I'm going to want to know, are you showing any rental income for that? Right. Rental income is a big deal. I need to know if we're seeing it, if we're not seeing it. Outside of real estate owned, then we dive into income. What are we doing for income? Are we retired? If we're retired, are we collecting Social Security income? Is it maybe a VA benefit? Is it pension income, dividends? I've had oil income, I've had farm income. I mean, we've had all types of income. I've even had clients qualify on casino winnings. So income matters, right? If you are retired, that's usually the most streamlined form of income, easiest to verify, quickest pre-qualification, because there aren't usually any variables with that, right? If I have Social Security at $1,800 a month, my Social Security is $1,800 a month, right? However, if you are taxed on that income or untaxed on that income, that allows us to do some other things with those incomes. For instance, if you're not taxed on that income, we can gross it up, which potentially gives you a little bit more buying power if we need it. Okay. If you are a W-2 employee, that income is generally pretty easy to pre-qualify. Your W-2 employees are usually, most Americans. Okay. But with that W-2, it's important to know how many hours a week you're working. If you are working less than 40 hours, 1 week you might work 40 hours. The second week you might work 36 hours. And then the next week you're working 48 hours. Well, we refer to that as variable income. And when you have variable income, we are obligated to take an average of that income. So through this pre-qualification process, it sounds like, I need to know every aspect of your life outside of your blood type, but this is why it's important, right? Because knowing this up front is really going to help us to avoid any challenges down the road.
And
Okay.
something you're probably going to come across, and I always do this, so I don't know, maybe I'm reading your mind. But I used to work in the mining industry, and I decided to move over to another industry, so it's two separates. So that can change thing on how long you've been there. Or if I went from the same industry to the same industry, and tell us, you can tell us a little bit about that in the pre-qual process on how you and what you got to look at there.
Sure. So if you are, let's say you work at McDonald's as a W-2 employee, right? Just straight 20 hours a week and $15 an hour. And, now I go get a job at the city, and now I'm actually 40 hours a week and I'm still W-2'd and I'm making $22 an hour. Well, to me, in lending, you're not obligated to be on that city job for 2 years in order for that income to be eligible. Okay. So that income becomes eligible. Now, if you are a McDonald's employee and you go and you want to be a truck driver. And now as a truck driver, you're paid per mile. Okay. We're required to have a 2-year history of this income being paid per mile because it is different than being just a regular hourly employee, right? The pay structure is different. Or my favorite is if I'm working at McDonald's, W-2 employee hourly, and I want to go be a real estate agent and I'm only 1 year into real estate and I want to buy a house, well, now I need a 2-year history with self-employed income in order to qualify you, in order to qualify that income. Okay.
And they generally want to see that income increasing from year to year, as opposed to if it's decreasing from year to year, that opens up a lot of red flags and causes problems, right?
Absolutely. If we have a decline in income, I mean, there's a small margin for moderate decline, but if we have a decline in income from year 1 to year 2, we're obligated to use that lowest income of that second year, which will affect how you're qualified. So when we're asking for these documents and I say, I really do need to see your year-end pay stub, if you're a commission employee or you get bonuses, or I say, I really need 2 years of your self-employed tax returns. It's not because I just want to give you something to do for the afternoon. It's because that information is really important, right? Same thing goes for commission and bonus income, or even tips. We see a lot of tips here in our community, right? So if you're collecting tip income, we have to average those. So I need to know what your tip income was for the previous year. How do I do that? Well, I get a year-end pay stub, right? So keeping track of your paperwork is important.
And cash tips don't count, right?
Cash tips do not count, not yet. And it's interesting with the new, the new administration. It doesn't matter what side of the line you're on, but if they are not taxing tips, I'll be curious to know how we will be able to utilize those in lending down the road, because we can only qualify based on the income that you're claiming. So tip compliance is really big on the Nevada side. What they actually make is much higher than what they're actually required to claim. But if you claim $400 a month, but you're really making $2,000 as a poker dealer, I can only qualify you on your $400.
I remember when there was a loan program out there that was a stated. Do they still do stated income? How much do you make? I make $1 million a year working as a greeter at Walmart. Mm-hmm. So I don't know if they still do that income or not.
There are several loan programs like that. We now refer to those as non-QM. We don't really call them stated anymore or subprime. We call them non-QM. But with those programs, you should have, or you are required to have, good credit scores, usually 720. And oftentimes you can expect 25 or 30% down depending on the property type and occupancy. So they're out there, but they're expensive. You'll pay higher rates as well.
I'm not making fun of anybody at Walmart as a greeter, and they are not sponsored. Obviously, after that statement, probably will never sponsor. But it was just being funny, trying to explain there used to be and there still are programs like that.
Back in the day, I remember them.
Yeah. I bought my first house using stated income, mm-hmm. and you said QM. What does QM stand for?
So QM is quality mortgage, which is your standard, FHA conventional VA, meaning we're following the guidelines that are set forth, for federally backed loans, right? Fannie says you need this, that's what we're following. When it's non-QM, right, it's sort of the new subprime, if you will. That's what we refer to it as, meaning we don't have to follow the exact guideline that Fannie and Freddie have required for us, because I only have 1 year of 1099 employment, that my client wants to use. So that's where the higher down payments, higher interest rates come in.
And that would be a situation where you're going with an investor outside of the normal, types of loans that are going to be sold in the secondary market.
Right. So I have a client who is self-employed, and this person has been in the same industry for 2 years, but the tax returns showed about $1,000 a month in income when they're really making about $300,000 a year. So instead of denying this buyer, we look at the non-QM 1099 program, because her 1099 tells me she's making $300,000 a year, right? Compared to her tax return that's telling me she's making $1,000 a month. So we take her through this 1099 loan program. Interest rate is much higher than standard market rate, but she was able to buy her house and, had a decent payment. And fortunately for her, she was already putting a substantial amount of money down. So outside of the interest rate, it really worked for her.
Is that the same? So that's probably the same as I remember now. All this stuff is coming back to way back in the day. Bank statement lending.
We have bank statement loans. Yep, you can do 12-month or 24-month bank statement loans. Those are decent loans. Oftentimes we see those for self-employed buyers again, who, nobody wants to pay taxes, right? So to see self-employed clients claim a deficit in income is pretty common, because who wants to pay taxes on a large amount of money? Not many people.
Yeah.
But I tell my clients this: either claim the income and pay the taxes, or don't claim the income, and I'm going to need a 25% down payment on your $500,000 house. So either way, you're spending the money. How do you want to do it? You're going to spend it no matter what.
Yeah. Now talk about stuff that as you look at, say you look at somebody's credit report and they've got three car payments on there, but then two of them are used for businesses, but they're showing up on their credit report. How do you handle that situation?
Right. So if I have a client who has several installment loans, I'll ask them, does your business pay any of your car payments? And some say yes, and some say no. And when they say yes, I ask them, okay, I look at the business tax return. So in most cases, we can omit the payments that the business makes if they are listed in the depreciation schedule of the business tax return, right? If it's not on the depreciation schedule, then I can't omit it, because your business isn't showing that they're, taking that obligation.
Now, does that payment have to be coming out of a business account for that vehicle? Or in some cases, I guess you could buy a vehicle cash and it wouldn't show up on a credit report at all, but that still gets added back into that income based off of that depreciation schedule?
Right. So if I have a situation where a business is making the installment loan payment, we would also have to see that payment deducted from the business bank account. Because if you're paying it from your personal account, but you're saying that your business pays it, how do you put the two together? Right? Because when you do your taxes, your business bank statements also come into play. Let me see what your business is spending, right? So it has to be on the business bank statement as well as on the depreciation schedule, and then we can omit it. Or we'll back up. If you're not self-employed and you co-signed for a loan maybe for Megan, right? And Megan's got this car payment, but she's been making it for the last 12 months from her own bank account. Well, you give me 12 months of Megan's bank statements and I'll highlight this car payment and I will omit it from your debt to income ratio. Okay. But if Megan missed a month and you had to pay a month, it starts all over.
So that's a situation like where a parent has co-signed on a child's loan would be a good example of that. But
Exactly.
it may or may not affect their qualification because, it's not even going to affect the qualification. It's going to affect the amount of their qualification.
Right. They're buying power.
Based on the debt.
Right. Yep. So with credit, typically when we start pre-qualification, I'll run a soft credit pull first. And the difference between a soft credit pull and a hard credit pull is the soft credit pull does not affect a credit score. Okay. It's sort of a glimpse into what kind of credit profile this client has. With the soft credit pull, it usually always only returns one credit repository as well. For us, it's Experian. For others, it might be Equifax or TransUnion. So it gives me an idea of what Experian is reporting for the credit. It also tells me what Experian is reporting for trade lines, right? How many credit cards, card payments, things are out there that they owe. So if I have a client who is, we're ready to go, we're rocking and rolling, I'll let them know, look, here are the debts that are reporting. If you want to buy a home at $500,000, based on these debts, our debt to income ratio is tight, or maybe our debt to income ratio is really low. If you want to write an offer today, we have to do the hard credit inquiry. So sometimes my clients will be fine with the soft pull and they'll kind of marinate in it for a day or so. And then they'll call me and they say, okay, let's do the hard credit pull, because now they've got this excitement because they know that they're on the cusp of being able to buy a house. And they know that the next step is to do that hard credit inquiry. With the hard credit inquiry, It does have an effect on your credit score. And Jared, you're probably going to ask me how many points. There's really no set amount or no set decline in a credit score when you do that hard credit inquiry. It really just depends on the client's credit profile overall. But if you're conservative with credit, it's usually pretty minor. With that hard inquiry, it's a complete credit report. So we have all 3 repositories, everything that reports to them, including derogatory trade lines. Derogatory trade lines are kind of can sometimes be a thorn in the side. And with those, if you have derogatory trade lines, okay, and they are charge-offs do not affect your buying power. Same with medical collections. Medical collections you're not penalized for having medical collections. Where you take the hit is in the credit score. Now, if you have a collection account, as a lender, we are obligated to take 5% of the balance of that collection and add in a payment for that debt. It doesn't mean that the client is required to pay it, but the guideline states if you have a collection, we got to throw 5% of that balance in there as a payment. And the reason that's important is because it affects your buying power, how much you can buy. Any questions so far about credit? I feel like I'm rambling a little bit.
No. I like it because it's very important. This is very educational to the people we have to work with on a daily basis.
What I would ask is at this point where we're talking right now, have they already submitted a formal application to you?
So this is right in the middle of the application, right? So we've
Right.
talked about income. Now we're talking about credit, and then we talk about assets. All right. One last thing about credit, and then we'll move into assets. A lot of times I will see clients dispute a trade line. When you dispute a trade line, okay, what it does is it basically freezes the reporting to the credit bureaus. And when you want to have a mortgage, if you have a disputed trade line, that has to be removed before you can move forward with your transaction. In most cases, there are some cases where it doesn't, okay? Because it doesn't give an accurate reporting of the scores, okay? So my clients will tell me, I put this in dispute because, I turn the cable box into DirecTV and they're just, whatever, to the cable company, excuse me. And they are saying that they didn't get it. Now it's a collection. And I tell them it's $300, pay the debt and move on, because keeping this thing in dispute and having this report month after month after month is just, it's going to kill you, let it go. So no disputed accounts, please.
Yeah, that's the old win the battle, lose the war scenario.
Yeah, eat crow. So we've talked about income, we've talked about credit. Now we move on to assets, right? What kind of money do we have for a down payment and closing costs? Because those are 2 different things. Are we taking money from our retirement account? Is it coming from a savings account? Do we have no money at all? And maybe our grandfather is going to gift us money. All of these things are important. Another one is cash. A lot of my clients will tell me, well, I have cash. Okay, well, what do we do with cash, right? Technically, your cash should be seasoned 2 months in the bank, right? That's the rule, okay? Oftentimes, I have clients who have family members who have sufficient funds and are able to gift them their down payment in lieu of having to utilize that cash in their transaction, okay? If I have a client pulling from a retirement account, right, we need to know what are the stipulations, something called terms of withdrawal, right? We're going to need that. And usually we can find those on our own, but in some cases we can't if they're kind of smaller companies. So we're going to go find those, because if the terms of withdrawal state that this has to be a primary residence in order for you to use those funds, but you're buying this as a second home, well, guess what? I don't have verifiable funds to mark off on your pre-qualification letter, right? So these are all things that we're going through. Outside of all of that, I take all of that information, I create a file for our client, and from there we determine budget. Okay. After I've determined budget, discussed interest rates, payment expectation, down payment, funds to close expectation with our clients, I issue a pre-qualification letter to the real estate agent. Real estate agent will then go find a house with the client. As soon as they find a house, I get a purchase contract. When that purchase contract comes in, we at that point upload all these documents that we've had from our client. Dot all the I's, cross all the T's, get the file over to the underwriter. The underwriter is then going to look at our file, look at all of our documentation, make sure we've covered all those points. right? Everything that we've discussed in this pre-qualification. Assuming the underwriter likes what they see, then they issue what's called a conditional approval. So a lot of folks think that when an underwriter issues an approval, my loan is approved, that's great. Technically,
I can go buy a car now?
yeah, do not do that. Technically, it's called a conditional approval. And in lending, the devil is in the details, right? You're not approved, you're conditionally approved, meaning you've given me all this stuff, but the underwriter would still like to see A, B, and C. Very common, okay? So then we'll collect A, B, and C items, okay? Get them back, give them back to the underwriter. He likes them, he signs off on them, we're good to go. While our loan is being underwritten, we're ordering an appraisal for the property, which, Jared, you're very familiar with appraisals.
I am. I've done a few of those.
One or two.
I've done a few for you, in fact.
Yes, you have.
Not directly. You're not hiring me, but you're the underlying client in a transaction, or the bank that you New American Funding is the underlying client, and you're the loan officer for the bank. But yeah, I mean, I don't know. Appraisers are always screwing it up for you, aren't they?
Not all of them. And, I noticed appraised values go in waves. So, right now we're kind of in this little space where we've had a few come back low, but, no biggie. We're able to save the deals. Jared, can you tell me from your side of things, what are you seeing for an appraisal turn time on average?
Currently, I'd say about a week. I think most appraisers, or if I find myself over a week, I'm probably not getting an approval when I quote the assignment, and it's going to go to another appraiser. We have several appraisers in our office, but it's tricky because we can't, if New American Funding through a management company assigns an order to me, Jared Rail, I cannot then assign it to one of the other appraisers necessarily in my office. They're assigning and it depends on the company, but they're assigning to a specific appraiser in most cases these days. The portfolio companies and some of the other companies out there that are not doing the traditional FHA, Fannie Mae financing have a little bit more. We have way more flexibility.
Mm-hmm.
We can move stuff around, which would be, that's how we would love to be able to do it in an appraisal business. Is I got 3 appraisers. I can send this appraiser to Bullhead City this week. I could send this appraiser to Kingman this week, and this appraiser can handle everything in Havasu. But no, we're all 3 of us are going to Kingman, Bullhead, and Havasu in the same week, which doesn't make a lot of sense. But that's kind of where the industry is currently.
Mm-hmm.
The way that it's structured, post crash of 2000. Like 2007, 2008, and the implementation of Dodd-Frank and everything else, that's when we kind of saw this current process go into place. And there's big changes coming in the near future, but we don't even know really everything there is to know about that yet. But new forms or form replacing all of the old forms. Scan to sketch as opposed to regular sketch. I'm a little leery on that, but I'm hearing it's coming, and I'm just along for the ride. We don't make the rules. We're just expected to implement, right?
This business is always changing, and if you're not okay with change, you may not make it. So Jared, thank you. After our appraisal comes in and we have all of the additional docs that the underwriter requested, then we submit our file for what we call clear to close. Once clear to close is issued, your file is technically approved. Now you are legitimately an approved situation. From the clear to close, we order your loan documents, and from there you will go to the title company, sign your loan documents, give them your down payment and your funds to close, and then we'll fund out your loan, and within a few short hours you get your keys. That is the pre-qualification and the lending process sort of in a nutshell.
All right. And do you have any other questions, Jared?
Actually, I think that pretty much is good, and I think would lead us into our next episode where we will dive into some of the other stuff, all of the nuances and stuff we might run into during the process, how the money is divvied up and things like that.
Yeah.
I think it's better to leave that for the next episode.
Yeah, and we'll save that because I've been jotting some notes down over here, so I'm gonna throw some wrenches in
Please
that are questions that I have, and I think it goes right in with all the stuff, the credit and everything we have. So yeah, definitely follow all these episodes, but number 3 is going to be loaded with some other stuff. Heather, tell everybody how they can find you and get their questions answered.
Absolutely. The best way to reach me is through my cell phone, 928-444-5900. Or if you're in Bullhead City, swing by the office. We're here Monday through Friday, 8 to 5.
All right, sounds good. All right, everybody, stay tuned. Let's see, whose names did I throw out there this time? Was it Walmart? Or was that the last episode? Anyways, we're not sponsored by anybody. I'm not putting anybody down. I'm not promoting anybody. We're just all a bunch of, and I wouldn't say we're professional in the podcasting system, but we are professional at providing you information, and that's what we're here to do. So look forward to it. Episode 3. We'll see y'all soon, and we'll talk soon. Thank you.
Thanks.